Welcome back to the deep dive. Today, we're looking at something, well, something a little bizarre. We're dusting off this piece of market forecasting history and asking a pretty wild question.
Which is, can the wisdom of a 19th century pig farmer actually predict the future of the S&P 500?
It sounds like a joke, right? But the data, as we'll see, is anything but.
Exactly. We are diving deep into what's called the Benner cycle. It's a chart created 150 years ago that seems to have pegged major turning points. We're talking the 2007 peak, the 1999 crash.
So our mission today is pretty critical. We're going to analyze the claims, we'll scrutinize the historical track record, which has some genuinely shocking numbers in it, and then we'll connect it all.
Right. We'll connect Benner's very specific 2026 prediction to, modern macroeconomic reality. The core question for you is this. Is a historical pattern from agricultural prices still relevant?
Or is it just a great story? A fascinating coincidence in a world that's now dominated by, what, $20 trillion in central bank liquidity?
And that 2026 date is looming large because the current context is already flashing red. The analysts we looked at are citing high debt levels, slowing growth, financial instability.
Asset bubbles, increasing recession risk. I mean, it's not a comfortable environment.
Not at all.
Okay, so let's unpack all this. We have to start with the man who started it all, the unlikely prophet himself. Samuel Benner.
Samuel Benner. So he was this prosperous Ohio farmer back in the mid-19th century. He had livestock, iron operations, was doing quite well for himself.
Until the Panic of 1873.
Yes, which completely wiped him out, financially ruined. But instead of just walking away, he got obsessed. He wanted to find the order in all that chaos.
And in 1875, he publishes his findings. It's this little book called Benner's Prophecies of Future Ups and Downs in Prices.
And what's so remarkable is that his work wasn't based on, reading tea leaves or some kind of spiritual theory.
No, it was grounded. It was based on practical agrarian science and math. He just looked at seasonality. He looked at how these predictable cycles affected crops, like corn.
Right. Which in turn affects pig feed, which affects the pig supply, which affects demand and prices. He was a true cycle observer.
So he noticed this 11-year cycle in corn and pig prices.
Yeah, with peaks every 5 or 6 years, a rhythm he even linked back to the known 11-year solar cycle.
So sunspots affecting weather, affecting crops, affecting market prices.
Exactly. And then he found these longer rhythms in pig iron prices and, most importantly, developed this longer panic-driven rhythm that cycled between 16, 18, and 20 years.
So he takes all this data, agricultural, solar, industrial, and he synthesizes it into 3 distinct categories for investors. It's basically a simple roadmap.
Super simple. The first one is category A. He called these the panic years.
Okay, what's a panic year?
It's a time of extreme fluctuations, irrational buying and selling. Fundamentally, it represents the very top of a bull market. It's the first big signal that it is time to sell.
Got it. Then you have category B, the good times?
Right. High prices, but specifically, this is the optimal time to be systematically selling off your stocks and assets. You're unloading them while everyone else is still euphoric.
And finally, category C, the hard times.
This is your bear market, the period of low prices where Benner says you should be buying stocks, goods, land, whatever you can, and just holding it until the boom comes back.
And the historical examples are startling. C years include 1924 and, get this, 2023. B years include 1926, 2007, and, most importantly for us, 2026.
And we should clarify one really crucial detail here for your memory. The years he marked, they refer to the end of that period, not the beginning.
Right. So 1999 is the peak before the dot-com burst. 2007 is the sell signal before the 2008 crash. 2019 suggested caution just before COVID hit. It's about when the party ends.
And this brings us to the numbers, the performance metrics. This is where it gets really, really interesting.
Great. Lay it on us.
So based on the historical data, since 1924, if you had just put a lump sum in the S&P 500 and held it until 2023, the classic buy and hold, your total return would have been 62,539%.
A fantastic result over a century. You'd be happy with that.
Very happy. But if you had followed Benner's cycle, so buying only in the C years and selling in the A or B years, your return would have been 126,692%.
Oh, wait. 126,000. That means you're outperforming buy and hold by, what's the math on that?
By staggering 217%. Following a 150-year-old agricultural chart would have more than doubled the market's return.
That level of outperformance is, it's statistically stunning, even if you account for the fact that backtesting is always easier.
It is. The data shows the directional accuracy. All the bull cycles that Benner designated, they showed really strong positive returns. That cycle from 2012 to 2019, it returned a whopping 156%.
That is genuinely unsettling. If this chart is demonstrably that effective, why isn't every hedge fund just running this system? Why are we even talking about it skeptically?
That is the critical question. And here's the catch. The data supports the general thesis, right? Being defensive during his predicted bear cycles pays off.
The average yearly return during his bull cycles was 6.4%. During the bear cycles, only 0.74%. So the pattern holds.
It holds directionally, but, and this is the major catch Benner cycle, completely, totally failed to predict the timing and the depth of the 2008 global financial crisis.
So the 1875 math, as one analyst called it, it just hits a wall when it faces a modern fiat-driven crisis.
Exactly, and that brings us right to the caveats. Before anyone prints out this chart and starts managing their retirement fund with it, we have to inject some modern skepticism.
The historical results are incredible, but they seem to break down the moment the central banks step in.
Benner was calculating cycles based on natural supply-driven systems. He couldn't have predicted modern fiscal and monetary policy.
Which is what we call the M2 problem. So what is M2 and why does it break a fixed calendar cycle like this?
M2 is basically all the liquid cash circulating in the economy. Physical currency, checking accounts, savings deposits, all the money that can readily flow into the market.
And when the Fed floods the market with it,
it just changes the game. It decouples price from the underlying commodity cycles that Benner was tracking. As of, say, February 2025, the U.S. M2 supply was around $22.3 trillion.
Trillion, with a T.
Up about 4.3% year over year. That kind of centralized intervention, it just destroys these rigid natural calendar cycles.
And beyond the Fed's influence, experts are pretty clear on another problem. Market timing itself is incredibly difficult.
Oh, it's brutal. Studies from places like Morningstar, Charles Schwab, they all show that trying to jump in and out usually just reduces your returns.
It's the cost of being wrong, I guess.
It is. One study found that those timing decisions cost investors about 1.7 percentage points per year over the last decade. And the problem is precision. Benner's cycle is a calendar. If you're off by 12 or 24 months, it can be devastating.
Like getting out too early in 1985 or 2012. You miss that final euphoric leg up. Or you're sitting on the sidelines waiting for that perfect C-year date and you miss a rapid rebound, like after the 2020 COVID shock.
Exactly. So the tension here is clear. The cycle is a great story. Its track record is hard to ignore. But as a rigid trading system today, it fails because the causal mechanism is gone. We're not in a 19th century crop and iron economy anymore.
Okay, so that brings us to the present. Despite all the caveats, the chart is calling for something specific. And soon.
It is. According to the chart, we are currently in a favorable period that's expected to run through late 2026. That's a B year.
Good times. Time to sell.
And that's supposed to be followed by a pretty challenging period all the way to the early 2030s, with 2032 maybe being a major low.
This prediction gets a lot more weight when we connect it to a modern cycle analysis, specifically the 18.6-year real estate cycle.
Yes, tracked by Fred Harrison, who's an economic analyst who famously predicted the timing of the last two major global recessions.
Okay, let's pause and explain that. Why would a real estate cycle, which is driven by land speculation, suddenly align with a pig farmer's chart from the 1800s?
Well, what's fascinating is how post-World War II policy seems to have altered the mechanism. Benner's cycle was tracking commodity flows, but after the war, government debt became the primary driver of market expansion,
fueling massive housing booms and land speculation.
Exactly. The research suggests this policy shift, this massive government debt, it basically transferred the panic mechanism from agricultural commodities to the land and property market.
So the policies didn't destroy Benner's cycle, they just switched its timing mechanism, the modern land-driven recession peak.
The one Harrison tracks. It now aligns perfectly with Benner's B year, the good times time to sell indicator.
So Harrison's work aligns directionally. He's saying the next major recession is imminent.
Yes, and he notes that the massive intervention during COVID actually pulled the timeline forward. It brought the speculative peak in housing and asset prices forward, possibly right into that 2026 to 2027 window.
So what this convergence means is that we have two wildly different, historically accurate cycles, one agricultural, one real estate. And they are both pointing to a major peak around 2026 or 2027.
And Harrison warns that the fallout from this could be far, far worse than 2008.
How so?
Last time, governments could step in and bail out the banks. This time, because of the immense sovereign debts globally, it's the governments themselves that are too big to fail, and there's nobody left to bail them out.
That's a chilling point. So, leaving the old farmer aside for a second, what other evidence-based signals support this caution for the 2026 timeframe?
Well, we have at least three major indicators that suggest the euphoric phase of this cycle is nearing its limit. First is the Shiller PE ratio.
Which measures market valuation.
Right. It compares the current price to the average earnings over the last 10 years, adjusted for inflation. The current ratio is 38.61.
And the historical average is what, like 17?
Closer to 17, yeah. So we are right near the 2021 high, and we're getting dangerously close to the 1999 dot-com bubble high of 43.31. It just signals significant overvaluation.
Okay, second indicator.
Total debt to GDP. This includes household, private, and public debt. The current ratio is high, around 270%.
So the global economy just has way less capacity to absorb another shock.
Dramatically less. We're already higher than we were during the dot-com era. The investor Ray Dalio suggests that prudence means reducing your holdings when you get close to that 300% mark. We're not far off.
And finally, the infamous yield curve inversion. This one seems to be the non-negotiable predictor.
It's the single most reliable short-term predictor we have. Every single U.S. recession since 1955 was preceded by a yield curve inversion. We're watching for the next time the government raises short-term rates enough to invert that curve again. It's a very strong sign.
And beyond just the economics, Fred Harrison also warns about what he calls a convergence of four existential threats.
Yes, military crises, migration crises, environmental crises, and what he sees as most critical, political paralysis. This inability of the ruling class to propose new, effective solutions.
So if you connect this to the bigger picture, this paralysis, combined with extreme debt, it could lead to, what? Philosophical despair.
That's one way to put it. And one speculative threat that was raised in the analysis we reviewed is what happens when this paralysis collides with rapid technological change, specifically autonomous intelligence AI.
And this takes us from market caution to a pretty profound philosophical warning.
It does. The argument suggests that AI, if it's imbued with humanity's current negative behaviors, the quest for profit and power without moral sentiment, it will eventually capture resources, especially energy.
Creating a kind of economic metaverse that needs humans less and less.
Essentially, yeah. Replacing the need for mass human labor, which would just accelerate societal friction. It's sort of the ultimate long-term consequence of letting these economic cycles run completely unchecked.
Wow. Okay. That is a lot to process. From 19th century pig prices to the future of humanity. So what does this all mean for you, the listener, trying to plan your portfolio for 2026?
My final analysis is that the Benner cycle, especially when you pair it with the real estate cycle, it works best as let's call it a sentiment compass, not a GPS.
Okay, a compass.
It's a reminder that markets have seasons: euphoria, panic, recovery. They're rhythmic. You shouldn't build your entire financial plan on a fixed calendar date, but you can use the direction of the cycle to nudge your risk posture.
So let's distill a simple, workable playbook from this. First, your core portfolio comes first.
Always. Own a low-cost, diversified stock and bond mix. That's your foundation, no matter what.
Second, use a risk dial, not an on-off switch.
Exactly. If you feel you have to react, do it with small tilts, a 5% to 15% shift in allocation. And critically, those tilts have to be guided by the hard signals we discussed, like the Shiller PE, not just a calendar date.
And finally, protect from yourself. The biggest drag on performance is usually your own behavior, driven by fear and greed.
So write down your rules now, your rebalancing bands, your preset hedges. Do it now to prevent emotion from hijacking your plan when a crash actually hits.
Preparing for a storm is always better than reacting to it.
Always.
So here's one final provocative thought for you to consider. Despite Benner's long history of accuracy and the convergence of all these modern signals suggesting extreme caution around 2026, the ultimate danger in the coming years may not be the market crash itself. It might be the political paralysis that prevents us from proposing new informed models to reconstruct society in the face of these converging global crises. That inability to act. That might be the real risk. Think on that, and we'll catch you on the next deep dive.